Welcome to the market update for March 2023, Belva Capital. Wow, what a month we've seen and what a first quarter in 2023. In March, it all started with the bankruptcy of the Silicon Valley Bank. Many have heard of you. What happened in the past, I don't want to repeat too much, but what was happened is very interesting for the market development because we've seen interest rates peaking in the US at around 5 to 5.1% from the 2-year treasuries, and they then lost almost 30%, going down to 3.6% yielding after 2-3 weeks. What happened to that? Because the market expected now a recession in the US and low interest rates. Flight to quality happened, and the peak of the interest rate cycle with the Fed is about to come within the next couple of weeks or month. And that was also the prediction then for the last Fed meeting, where they just raised only 25%, which they expected, the market participant expected the beginning of the March was 50%. So this is exactly what fueled the markets from the lows in the March to almost new highs for the year. Not all indices, but major indices now already left the bear market cycle. How do you define it? All major indices are above the 200 moving averages. We have higher 50 days moving averages and also higher 100-day moving averages. And on top of that, from the lows we've seen last year, we appreciated roughly 20% from the lows. Some indices even above. So nobody knows if we already left the bear market or we're still in the bear market or we're already again in the in a bull cycle. As we've seen that in the past, nobody will know. So the next earnings season, which will start in April, May, will tell us how the corporates really cope with the high inflation, with the high interest rates, and if they are able to roll over their costs and their high costs of inflation into their prices. So it's going to be very interesting, but with an already very high level of the indices this year, we might see also a little bit of a correction again in the next couple of weeks, but what we've also seen in the past 3 months, and especially in March, quality was key. All those companies which have strong balance sheets, low debt to sales levels, low debt to market cap levels, they could really outperform. Especially the tech companies came back, like the Googles, Apples, Facebooks or Metas, and on top of that, Microsoft with the new ChatGPT, which everybody's talking about, went to new, really great levels. Not to the all-time high levels, but not far away from that. Who expected that at the end of last year? So this first quarter was a little bit of a surprise to everyone because we expected a recession. We have seen lower levels in February and even mid-March, and now we are back in a positive market environment. And once you've watched your portfolios and your diversification, you should have benefited in the last couple of weeks from that upswing. Gold also appreciated, and the US dollar we've seen very weak. Why? Because we peaked the expectation of interest rates and the euro appreciated against that. What we've seen as well in the market is flight to quality. This means also flight to gold, because when there's financial stress and there's contagion, we've seen always that gold appreciates. And this is a well diversified for all portfolios, and we've seen that as well. And the ones who have not followed that goal, they can take participation into gold shares, which underperform the gold price. So we see a little bit of a gap in between the gold miners and the gold price. And we expect that to continue to narrow down over the next couple of weeks. So it's going to be very interesting what the earnings seasons will tell us if the corporates are really performing well and how they can cope with the inflation and the high interest rates, and how they can pursue with the sales within their sectors. Stay tuned.